This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 10, 2026, and this is the New York pre-market. Now, let's get into it. Tech is leading the charge with QQQ up 1.66%, pushing right against the $730 mark, while the broader S&P 500 hovers at $751.71. But beneath that green surface, the yield curve remains deeply inverted and inflation persists, creating a fractured market where technology soars while energy and staples retreat. Let's look at what's driving this divergence. On the agenda today, Delta Airlines reports earnings with an estimated earnings per share of $1.44, offering a snapshot of consumer travel demand. Later in the week, starting Monday the 13th, the Big Four banks, Goldman Sachs, JP Morgan, Bank of America, and Citigroup, take the stage. These prints will test whether the financial sector's current resilience can withstand the pressure of a 4.56% 10-year yield. Here is the morning picture. The S&P 500 sits at $751.71, just shy of its July 6th high of $752.41. The Nasdaq 100 ETF is stronger at $723.28, up 1.66%, fueled by a 2.18% surge in the technology select sector SPDR. Meanwhile, the Russell 2000 is at $297.24, up 1.28%, but lagging the large-cap tech leaders. The VIX is calm at 16.9, suggesting low volatility, but the underlying macro signals are anything but peaceful. Three headlines are shaping the board today. First, Meta Platforms is gapping up 4.3% following headlines around an AI cost breakthrough. Second, Coinbase is also jumping 4.4%, though on abnormally low volume, just 0.3 times normal activity. And third, MicroStrategy is matching that 4.4% gain, tied to Bitcoin's broader recovery narrative. Pulse, the volume on Coinbase is striking. Does that 0.3x normal volume signal conviction or a trap? It's a trap. When you see a 4.4% move on less than a third of the usual volume, you aren't seeing institutional accumulation. You're seeing thin air. The VIX at 16.9 confirms the complacency. We are in a regime where fear is suppressed, but that suppression makes us fragile. If that liquidity vanishes, which it likely will as the day progresses, the 4.4% gain evaporates instantly. This isn't a broad market signal. It's a speculative itch that needs scratching. CIPHER, let's dig deeper into the leader here. Meta is up 4.3% on an AI cost breakthrough. Is this fundamental, or is the market overpaying for the narrative?
It is fundamental, but narrowly so. This is a single-name driver propping up the technology sector, which is up 2.18%. Without Meta's specific efficiency narrative, the technology sector lacks organic breadth. We are seeing capital flow specifically into names that promise margin expansion through AI rather than general growth. It's a tactical rotation, not a cyclical boom. If Meta's guidance doesn't match this valuation premium, the sector faces immediate headwinds.
SPECTER, you've been watching the yield curve. How does a 4.56% 10-year yield interact with a market that thinks AI solves everything?
It doesn't interact well. It clashes. The 10-year yield is stuck at 4.56%, and the curve is inverted by 0.38 percentage points. That inversion is a historical recession indicator. Right now, equities are ignoring that reality. Energy is down 1.4%. Staples are down 1.41%. Capital is fleeing safe, rate-sensitive assets to chase the AI narrative. That is a dangerous disconnection. When the monetary reality bites, which it will given CPI is still at 4.17%, those speculative gains unwind faster than they accumulated.
Let's turn our attention to the charts. Grid, the S&P 500 is at $751.71. We are inches from the $752.41 resistance level established on July 6th. Can we get a clean breakout here?
Structurally, it's fraught with risk. We are pressing the $752.41 level, but look at the breadth. Diamonds is barely moving at $524.19, up just 0.27%. The breakout in SPY is being carried almost exclusively by tech. If SPY cannot close above $752.41 on expanding volume, we are looking at a liquidity event, a fake-out that traps buyers. The 10-day range is $716.58 to $752.41. Hitting the top of that range with such narrow leadership usually results in a rejection wick back toward the 745 level.
What about QQQ? It's at $723.28, sitting just 0.9% below its $730.83 high. Are we setting up a double top there?
Absolutely. QQQ is hovering at $723.28, trying to reclaim $730.83. If it fails to breach that 730.83 level on high relative volume, we establish a bearish double top pattern over the last 5 sessions. The danger here is the volume divergence. Meta is moving on high conviction, but as Pulse noted, coin is moving on 0.3x volume. That lack of broad participation in the Nasdaq components means there is no structural support to absorb selling pressure if the 730.83 ceiling holds firm.
CIPHER, from a fundamental standpoint, does the current valuation of QQQ at $723.28 make sense given the earnings backdrop? We have DAL reporting today, and the big banks next week.
It makes sense only if you believe the AI productivity gains can offset sticky inflation. We are seeing a massive rotation into the technology sector, but it's isolated. The concern is the consumer. Delta Airlines reporting today with an estimate of $1.44 earnings per share is the litmus test. If discretionary travel demand is weakening, then the 1.34% gain in consumer discretionary today is misleading. We need to see if the consumer actually has the purchasing power to support these tech multiples. Until we see broad earnings beats, not just Meta, we are trading on hope, not fundamentals.
SPECTER, you mentioned earlier that the yield curve inversion is a cliff edge. How does the inverted curve specifically threaten the QQQ breakdown scenario?
It turns the breakout attempt into a value trap. A technical breakout at 730.83 requires capital commitment, but with the 2-year yield at 4.21% and the 10-year at 4.56%, borrowing costs for those tech firms are effectively locked at high rates. There is no easing cycle coming to refinance debt or boost valuations. The inverted curve means the financial system is tightening. Even if stock prices are rising, that tension eventually snaps. The soft landing narrative is being priced into QQQ, but the data, core PCE at 3.41%, suggests hard landing risks are being ignored.
Let's shift gears to the small caps and the broader market breadth. IWM is at $297.24, up 1.28%. Grid, is there support holding here, or are we seeing cracks?
Support is testing the $294.90 low from July 9th. IWM is at $297.24. It's recovering but slowly. Compare that to the technology sector's 2.18% surge. The Russell 2000 is simply not keeping pace. This lack of participation from smaller companies is a classic sign of a fragile rally. If IWM drops back below 294.9, it signals that traders are retreating to safety, or at least to mega-cap tech. The gap between the winners, the technology sector, and the average IWM is widening, which is unsustainable without a catalyst.
Pulse, does the Russell's lagging performance change your read on sentiment? Or is the complacency solely in the large caps? It extends the complacency dangerously. The fact that investors are skipping the broad market entirely to concentrate in the technology sector means there is very little hedging happening elsewhere. The VIX at 16.9 is low precisely because everyone thinks the rally is safe. But when the rotation is this one-dimensional, only tech and consumer discretionary up 1.34%, you have a house of cards. If sentiment shifts on a single bad headline, that concentration becomes a liability. Everyone is long the same three things, and there's no room for error. Finally, let's look at the laggards. Energy is down 1.4%, and consumer staples are down 1.41%. SPECTER, you flagged these as stress indicators. Why are capital flows fleeing these sectors right now?
Because they are victims of the rate structure. The energy sector and consumer staples are traditionally defensive, but when yields are at 4.56%, the opportunity cost of holding low-yielding staples or cyclical energy against high-flying tech becomes intolerable. Investors are forced to hunt for yield in growth names because dividend yields in staples are insufficient against inflation. This isn't strength in tech, it's capitulation in value. Once the inflation data forces a rethink, these sectors might snap back, but for now, they are being bled dry by the inversion.
Apex, bring it home. We have a tech-led rally testing key resistances, a narrow breadth, and a macro backdrop that seems to contradict the price action. What is the structural takeaway?
The structure is a contradiction. Grid flagged the SPY resistance at $752.41 and the triple Q double top risk at $730.83. CIPHER highlighted that this move is entirely dependent on Meta's specific AI narrative, lacking broad earnings support. SPECTER warned that the 4.56% 10-year yield creates a fundamental ceiling for valuations. The synthesis is simple. The rally is valid technically but fragile fundamentally. The market is pricing in a future where AI solves macro problems, but the present data, inverted curves, sticky inflation, and low-volume speculative moves in coin, says otherwise. Unless breadth improves and yields cooperate, these technical levels are likely to act as ceilings, not floors.
So, the key takeaways for the session. First, watch the SPY level at $752.41. A failure to hold there could expose the narrow leadership of the technology sector. Second, monitor Delta Airlines' earnings as a gauge for actual consumer health beyond the tech bubble. And third, be wary of the low-volume moves in crypto-adjacent equities. They offer no structural support to the broader market. Thank you for joining the ShadowQuant Equities edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.